Well, let's talk markets and let's talk about what it takes to achieve a true market bottom. The first thing, though, I have to say is we are living through financial history because we have never before, not once, seen the Fed tighten policy into an official bear market. There's a first for everything, and we are living it through real time as the Fed tries its best to chase inflation and get it from over 8% down to 2%. And there'll be all sorts of repercussions along the way, and we are at the thin edge of the wedge in terms of what's happened so far this year. Now, as for the economy, the bottom line here is this. A 23% drawdown in the S&P 500 over a 6-month time span, which we've seen in real time this year, has resulted in a recession 100% of the time over the past 5 decades. That is a 5 for 5 track record. Now, that's important because it also leads us to a view as to why it is that the bear market can't possibly have ended. Because these are the things that have to happen for a market bottom, a true fundamental bottom, to truly take hold. Hear me out. Point number one. A full mean reversion of the PE multiple compression that needs to be achieved. We are only halfway done. That has been the big story in this year's correction, has been the price earnings multiple compressing, only halfway down the mean reverting process because of the sky high levels that we started the year at. Point number two, relative valuation support from a decline in bond yields. We need to see that. On average, the 10-year Treasury note yield is down 160 basis points from the highs when the stock market bottom is put in. The stock market bottom needs bond yields to go down. That's only actually started in the past week. And at the lows, by the way, we typically see this dynamic occur. At the stock market lows, most people don't know this, the dividend yield and the 10-year Treasury note yield converge. So that means that we either need to see the 10-year Treasury note yield retreat all the way back to 1.6%. And if we don't get that, then the hard work has to be done by the stock market, which means the S&P 500 has to go back to 2,200. Or perhaps we get something in between those two levels on bonds and stocks. Point number three, we need to see a shift from the Fed, and not just to the sidelines, but towards a brand new easing cycle. Now that will come, but it's not around the corner. It could be next year's story, but the Fed is barking more and more about the need to continue to go 75 basis points at the FOMC meetings. So put that in your back pocket, maybe for the end of the year, next year's story, but there is no stock market bottom until the Fed switches to an easing posture, full stop. Fourth point I want to make is this, that we have to see that the signs of the recession are heading into the mature stage. You see, the stock market is a forward-looking barometer. It will look to the next cycle, but you see, normally the S&P 500 bottoms 2/3 to 3/4 of the way through the economic downturn. This recession is just getting started. So here's what it all means. To get to the 2% inflation that the Fed wants so desperately, they have to deflate the other 80% of the consumer price index, the part of the price index that isn't food or energy. They have to deflate that 80% of the CPI by negative 1.8%. That's never happened before. In fact, we haven't seen a negative core inflation number in the United States since the Great Depression. So the sort of demand destruction that the Fed would need to engineer would have to be a 2008 style of negative 3% GDP recession, which would take the unemployment rate from 3.5% today to 6.5%. So things are going to get very rough if the Fed is to be believed, but the bottom line is that they are barking, but they're also biting. So what does this mean for the markets? Well, remember that the Fed always and everywhere influences the economy through financial conditions. Question is, how far do these financial conditions have to tighten to bring the economy to a state that would then have the Fed feeling comfortable that inflation is coming back to its 2% goal. Well, financial conditions to a central bank is basically code for two things: S&P 500 and high yield bond spreads. So the answer, and we've done the modeling work on this, is 3100 on the S&P, over 700 basis points for high yield spreads, which is basically at least 200 basis points wider than what we have in our hands today. So if you have to be fully invested, I'm thinking defense stocks and I'm thinking defensive stocks, all the sectors with no correlation to the economic cycle, like utilities, like MLPs, like healthcare, consumer staples. As for treasuries, the bear market here is in a far more mature stage than it is for the equity market, and there is already a ton of inflation and Fed priced in. What isn't priced in is the recession staring us in the face. And all I know from studying all the past 11 recessions back to 1950 is that the long bond, the 30-year treasury, makes you money in total return terms in recessions, no matter what the starting point is for inflation, because inflation declines in all recessions, including the three horrible stagflation periods from 1970 to 1980. So while equities always lose you money in a recessionary bear market, the only question is magnitude. Treasuries always make you money. Time to buy bonds.